Hello and welcome to BQ Prime. You're watching IPO Adda, and my guest today is from Updater Services. It's a company which is involved in business and facility management services with pan India presence. Its IPO is opening on 25th of September, closing on 27th. Price between 280 to 300 rupees. Fresh issue of 400 crores and OFS of 240 crores. So the total IPO size is nearly 640 crores. And joining me is Mr. Raghu Tangirala, who is the chairman and managing director of the company, and Balaji Swaminathan, who is the chief financial officer of the company. Gentlemen, thank you very much for joining us on BQ Prime. My question first to you, Mr. Tangirala. You're raising 400 crores in the IPO as fresh equity. What is the purpose of that?
We had mentioned in our RHP, but anyway, since you asked, about 150 crores for retiring debt, then about 130 crores for future working capital, and about 80 crores of blind pool for inorganic, and the balance is for general purpose.
Mr. Swaminathan, he spoke about retiring debt. What is the kind of debt that you're holding in your balance sheet? What current and non-current together?
Look, current and non-current together, we have about 172 crores as at March 23, and out of which 133 would get retired from the proceeds that we get from the IPO.
Okay. You're mentioning that you're needing 115 crores in working capital. It's a services industry. It was very rare to see services industry requiring a higher working capital requirement. What is the reason for that?
This services industry here, the people cost is the major cost, where you do not get the credit, unlike other businesses. And the credit period that we offer to the customers, we have to fund for at least couple of months, one running month and the one based on the credit period. So that is the reason why we would need working capital in the services industry.
So, if I'm correct, you have this entire period of nearly 3 to 4 months for the services that you offer and the revenue that comes from it.
Not 3 to 4 months, so it would be closer. If you take the net working capital, it will be closer to about say 75-80 days. Is the debt that is the working capital that we put.
Is the entire industry works in that kind of working capital cycle, in the sense 75 to 80 days kind of thing?
Yeah, it would, because 1 month is a current running month, salaries I have to pay, and similarly one is the billing, and then I have to wait for the credit period to collect. So in that sense, including unbilled, it would be the similar number.
Mr. Tangirala, I was looking at your growth. It's been a very aggressive growth in the last 3 years, but it's mainly led by acquisitions in the last 3 to 4 years. From FY19 to 2023, 4 acquisitions you have made. And that has helped you push your revenues also higher to over 2,000 odd crores. My question is that, is this the kind of growth strategy that will play out going forward?
It would be the strategy, but need not be the same scale. However, since you mentioned it, even organically we've grown about 15%, and minus the COVID year or COVID 2 years, we've done about, Balaji, what about 25% growth? 20%?
Around 20%.
Around 20% CAGR. I'm talking organic without the acquisitions.
Okay, so the 40% jump in revenue that has happened between FY22 to 23, you're saying that around half of that would have been through organic and the half would have been through inorganic growth coming in. How easy it is to scale up in this industry, because you are a manpower driven industry and it requires skills, as some bit of skills as well. So what is the how do you plan out your manpower requirement, and how do you train your skilled employees?
This is our business, so this is what is our strength. We keep doing this. This is what we've been doing all our life. We've got sourcing teams in every state. We've got sourcing teams where it's labor surplus states. And we have a strategy on this. So every day we recruit. There's a training happening across the country. So this is our business. This is our strength.
Mr. Swaminathan, can you give us a sense of what kind of salaries or packages is what you give your employees? What is the average salary for the facility management manager or the worker who's working in there?
Look, I would look at the whole thing, split it into, to put it into perspective. So one is on the IFM business, where the salaries are pretty much more closer to the or slightly above the minimum wages which are required under the statutes. And when it comes to BSS, the kind of employees and the skill set that is required is much higher than what IFM is. So in that sense, there the salaries are much higher than the minimum wages. So on an IFM side, you would see an average of, say, depending upon the state, maybe around, say, a 20K, 15 to 20K would be the range depending upon the state. And with respect to the BSS, it would be the lowest itself would be upwards of, say, 25 or 30K per month.
And how has been the wage cost inflation that has come in? We have seen post COVID there has been a lot of inflation coming on wage costs across the board, across industries. How are you managing that, and what is the kind of wage hikes that comes in? Because since you are in the services industry and you have nearly 65 odd thousand employees with you, how do you manage that wage cost, and what kind of wage hikes that we see on an annual basis?
Yeah, look, whatever is the increase that is there, which is as per the industry that is there. But again, just to highlight here, the contracts that we have with our customer are executed, negotiated in such a way that any increase in the minimum wages or the statutories also gets billed to the customer. And apart from that, I would have my margins that we need to bill in. So in that sense, the inflation will not have any significant or a major impact on our numbers. So these are more as part of my cost, which are pre-agreed with the customers to be billed back to.
Mr. Swaminathan, the statutory wages haven't been hiked for many years now, right? Means we haven't seen year-on-year hikes that comes in for statutory minimum wages. So in that sense, how do you manage hikes? Because how do you manage the churn that happens? Because I understand the churns are also very high in this industry. So how do you manage that as well?
So just to add there, I'll just chip in. I haven't seen in the last 10 years where the increase has not happened. In fact, I've only seen it happening more and more. Earlier, it used to be roughly about 3 to 4%. Now the average is 5 to 6%. At no year I've seen where the wage hike has not happened.
Okay.
In fact, in many states, it's twice in a year.
And
like what Balaji said, it's a pass-through for us.
Okay. So, and it's built in your contracts when you do that?
Sorry, come again?
It's built in your contracts, wage hikes are built in your contracts?
Yes, they are.
So, in that sense, what is the kind of margin that you keep between the cost to the client and between yourself?
Okay, we roughly operate in the IFM space. I'm not talking of the BSS space. Around 10 to 11% gross margins.
Okay. And in the BFM space?
It's anywhere between 18 to 22% because there are different businesses.
Okay. Give me a split of both the businesses. How much of revenue comes from IFM and how much from BFM?
March 23, we had about 1,800 crores from IFM.
So just to give you a split, so it's about 22% has come in from BSS, and the balance, the 78% is coming in from IFM. Sorry, 72 from IFM and 28 from BSS.
Yeah.
Okay. So in that sense, is the endeavor to go more, lean more towards the BFM business, which has higher gross margins going forward?
Absolutely, that's the strategy.
So
and also, if at all we are doing some inorganic acquisition, it'll happen in that space. Just to put it in perspective, IFM is about 5% margin business. Our BSS is about anywhere between 14 to 15% margin business.
Okay. Give me a sense of your EBITDA margins, Mr. Swaminathan, because I was looking at your numbers at 2,100 odd crores of revenues. Your EBITDA was around 92.5 crores. That gives an EBITDA margin of 4.4%, core EBITDA margin I'm talking about here, versus 5.3% last year. So your EBITDA margins have contracted over last financial year. What is the reason for that?
Yeah, so look, the way over a period from 20, if you look at the EBITDA margins have moved from 5% to about 6.8 or 6.9 in 2023, right? And this is primarily what you're seeing as a reported EBITDA has got a couple of components which are there, as we have explained in our document as well, which is relating to a fair market fair value adjustment for the liabilities that we need to pay for the promoters, right? So which is more of a capital nature. But having considered the Ind AS, the way the accounting is done, so that also gets into the P&L, because of which the EBITDA is, the reported EBITDA is contracting, right? So otherwise, if you look at between FY22 and FY23, our adjusted EBITDA has moved from 108 crores to 145 crores. So there is an improvement and there is an increase, and the percentage wise also it is more or less around 7-ish, right? So we need to just take this perspective, and there would be a similar implication on the PAT as well when we look at these adjustments and then do.
Can you elaborate a little bit more on these adjustments and how this is done, especially the one related to promoter?
Yeah, so this is basically relating to the acquisitions that we have done, right? So these are committed acquisitions that we need to go ahead and acquire 100%. And generally we do a tranched acquisition. In the first year, we would do a majority, and then over the next 2-3 years, based on the earnout model, we would be acquiring the balance stake from the existing promoters, right? And if the subsidiary is performing, so actually it is a good to have a problem, I would say, because subsidiaries have performed much better than what we have estimated in the initial time when we have acquired. So because of which what happens is at the time of acquisition, on the date of the acquisition, we would estimate what the subsidiary would do, and based on which the total consideration is taken as a liability. And now because they are doing better than what we have estimated, there is an increase in the purchase consideration that needs to be paid, and that needs to be fair valued at every period end. And when we do that, there is a additional payout that is coming in that needs to get into the P&L. I will not be able to go back and increase my investment value. So because of which it is impacting the reported EBITDA. And ideally, if you look at it, this is more of a capital nature. This has got nothing to do with the operations.
So, give me a sense of is this going to be there for the current financial year or the financial year later? Because you said that the acquisitions are based on tranched, and you take the majority at the first go, and then you take it in tranches. So, how many tranches will it be, and will this have an impact in the current financial year or the coming financial year?
Yes, there would be some impact, assuming they are performing better. But again, this quantum will come down, because every year when I am acquiring the additional tranches, only for the balance, this would have an implication, because I have already crystallized and paid for the already concluded tranches. So in that sense, the number would be lower than what it is there in the current year.
What would be the total liability, outstanding liability in this regard?
It's as of 31st March 2023, it's about 175 crores, which is there, which needs to be paid for two acquisitions, which is Denave and Athena.
And Athena, basically.
Yeah.
So
both are, Denave and Athena both are into sales enablement.
Okay, so this is 175 crores, right? That's what I heard. So it has to be apportioned over the next couple of years, basically.
No, this is the total liability. So if this 175 crores is based on, say, just a hypothetical number of, say, 100 crores of EBITDA, and if they perform 110 crores, right? For the 10 crores additional which is there, and for the balance stake that I need to buy, I need to basically fair value this 175, which could be higher or which could be lower. So to that extent, whatever is the differential that is coming in, that would hit the P&L. Otherwise, this 175 is the total liability that I need to pay for the balance tranches as of 31st March 2020.
So, and this has to be paid within next 2 financial years, including this one?
Yes. So
the reason why I'm asking is that how many financial years will this will be apportioned into?
No, this 175 will not get apportioned. Okay. So what would happen is this 175 will get revalued at fair valued at end of the period, and if the liability say goes up to say 180 crores because of the better performance, only that 5 crores will be taken as part of the P&L. Okay. Or if it becomes 170 crores, then 5 crores will be a release in the P&L. Okay. Because my investment would remain the same. So in that sense, when I'm acquiring, generally Denave I have to acquire by next year, which is 24-25, based on 24-25. In 24-25, I need to do. Athena, I would be 100% by 26.
Oh, okay. So you will have complete control of these two companies in the next 2 financial years, to be precise. Give me a sense of internal controls that you have in your company. Mr. Tangirala, because I saw one of the risk items which where the auditors has raised with respect to you know comments which respect to bogus billing and payments to ex employees. So what is the kind of internal controls that you have set up post that and I think the investigation is still pending or is on the verge of completion. So where are we on that, and how do we how is the company now getting to bring in those internal controls?
Yeah, as of now, just because you mentioned the investigation is completed, but however, the point is how we strengthened our controls. Now, look at it, we've been in the business for about 35 years. This has happened in spite of all the controls, in spite of all whatever systems we have. So now, because after this happened, we've done an investigation, we have identified if there are gaps, and then we put in controls in that for these kind of ghost employees not happening. So that's unfortunate. But however, even earlier we had all the controls. In spite of it, people can do something. So we've identified the root cause, put in systems. We put in a biometric in every account today. But even with that, it is still possible. So what we've done is we've done kind of surprise audit happening across all our clients. Because in spite of having biometrics now everywhere, it still could have been possible for ghost employees.
Mm-hmm.
So this is the additional kind of a measure we've taken to do a surprise audit at least once a month, all our accounts.
Okay. Where
This
are
is
we
in addition to the regular controls what we have.
Okay, where are we on the whistleblower complaint which you have mentioned in your risk factor?
Balaji, can you take that? Because
look, both the ghost employee and the whistleblower complaint both are concluded. So the amounts involved are very immaterial. So as we mentioned in the RHP, the impact is about 51 lakhs, which is with respect to the one of the instances at the client side. And this amount has been fully provided, so we do not have any open whistleblower complaints which are there. So in 2023, we have not received any whistleblower complaints.
Even the whistleblower complaint, it was not of material.
No,
it was about 5 lakhs or something. And the other ghost employee was about 50 lakhs over 8-year period.
Okay. Give me a sense of, sir, you're working with such a huge workforce. There are now regulations coming in, or the labor codes which are going to come in. They've been not been notified, but they have been put in public domain. How will that impact you going forward?
Actually, that's a blessing for us. It will regularize many things which we are already doing, and it will actually help us and simplify things. It would actually be very helpful. For example, many of the policies or many of the statutory liabilities, all that gets much more better and streamlined with this new wage code.
And today,
and also our paperwork will come down by 1/10.
So today, all your employees have a basic social net like a PF or a insurance, everything in place, right? Means anyone who's working for you, whether contractual or on your roles, permanent roles, they have these facilities.
Of course,
yes.
That's by the rule, and from the day we have started the business, that's been there.
Okay, sir, over 4,000 point of contacts that you have, or buildings where your facilities are there. How do you see growth in this market? Because we have increasingly seeing third service participation for facility management or business management increasing. What kind of opportunity that you see? You've been growing at a fast organically 20%, inorganically another 20%. But as you go forward and increase your in your play and the geographical reach, what is the kind of opportunity that you see, and where do you see maximum opportunity coming in?
See, the facilities management or the maintenance services business is growing at about 15 to 17% is what the industry report says. Could be a little more than that also. Roughly what we do, we have a business research team with us. Roughly in this country, about 50 million square feet gets built every year now. I'm talking of A-grade commercial space. So that's our opportunity. So we have always grown above what the industry grows, and it could be in the range of about 18 to 22%.
And
So this is where this FM business will go.
and do you see a hyper competition coming into this segment?
I don't see hyper competition, but there is enough competition.
And what about contract renegotiations that come in? Do you see pressure coming in from clients, and especially on how integrated facility management IFM segment, where the pressure is
Yeah,
much more in reducing costs, reducing and getting more services out?
absolutely, you're right. I'm happy you asked me this. So what we do is we keep on adding value in terms of innovations, technology, bringing down the price and bringing efficiency up. This is a process which goes on day and out every day. So just to answer on whatever you said on the customers, I'll give you a real data. If you take a 5-year window, our attrition has been 5%. That means I retain 95% of my clients on a 5-year window.
Okay.
So that means what we are delivering what the customer wants.
And these contracts that you sign with your customers, are they multi-year contracts, or is it yearly contracts which are renewed every yearly?
Okay, most of them are yearly. Let's say 70% are yearly, 30% is anywhere between 3 to 5 years.
And these 3 to 5 years have escalation clauses every year.
Absolutely, all these have got to pass through.
Sir, is there any other services that updater can enter into going forward, or you're looking to enter in going forward? So I'm asking this because you have earmarked nearly 80 odd crores for inorganic growth. Are there new areas which you want to look at and enter?
We don't have any targets now, but definitely we know where we want to do the inorganic there. We will be doing the BSS space.
Okay. So only to targeting the BFSI basically.
That is the business support services.
Okay. And
Where we already have that.
and you're not looking at new segments, adding new segments in your services?
No, it could be new segments, but in the business support services.
Okay. Gentlemen, it was a pleasure talking to you today. Your IPO is opening on September 25th, closing on 27th. Price between 280 to 300 rupees, fresh issue of 400 and OFS of 240 crores. Total IPO size of 640 crores. And if I look at the equity which is an offer, it's nearly 32% of the post-issue equity capital of the company. Thank you very much for joining us on IPO Adda.
Thank you so much. Thank you for having us.
Thank you.